Okay, so um, March 4th, this is a review of what we did in the last problem. It's just issuing this stock, but now we have that issue with the par value. So on March 4th, we're trading cash for stock in the company, and we're going to have common stock, $1 par value. We're also going to have paid in capital in excess of par. So hopefully you remember this added little detail. So we're issuing the shares at $18 a share, and there's 22,000 of them. So that's how much cash we're bringing in. And of that, 22,000 shares times the par value, which is $1 a share. And then the remainder is going to be paid in capital in excess of par. Okay, so hopefully this was review. We did a whole problem on this before. But now we're going to talk about the treasury stock transactions. So the first one, we're going to basically buy back 1,400 shares. So May 22nd, this time we're going to be spending cash. And you can figure that out by just doing $11 per share times 1,400 shares. And we're going to have that stored in this treasury stock common. Okay, so now we have this $15,400 debit balance. Okay, so now we're gonna sell 500 of these shares for $24. So did we do a good job? Were we smart? Yes, because we bought at 11 and now we're selling it back to the market at 24. So we're gonna have a profit here. We're gonna have to use that other account that we had, which was an adjunct account, right? It's also gonna be credit. Okay, so let's just go through the steps here. So we're receiving cash. This is on September 22nd. We're going to get cash, $24 a share times 500 shares. We're giving up treasury stock. And again, this account is always going to be accounted for at the cost basis, like the cost per share. So we bought these at 11 and we are selling them. There's 500 shares that we're selling. Okay, and then the remainder is going to go into this paid in capital from treasury stock transactions. So this is kind of like the profit that we earned from this trade. Okay, so this is going to be 6,500. This is going to be, okay, so remember, we kind of need to track the number of shares too. So this was originally 1,400. We just sold 500. So we still have 900 shares left at $11 each. Okay, so right now, I guess we can do a little balance as of now. This is 900 shares. Okay, so now there is another transaction. We sold the rest of them. Basically, we're gonna sell the rest of these 900. And this time we're taking a loss. We're selling them at $9. We bought them for 11. So what we'll do is, again, we're gonna be receiving cash, 900 shares times $9. The treasury stock is going to be transacted at our cost basis. And basically, this is going to go to zero, right? We already kind of know the amount. This is going to have to be 9,900 because we no longer have any shares. We should have a zero balance, 0 shares. And again, we can confirm that by doing 900 shares times our cost basis of $11 per share. And then in order to make this journal entry balance, we're going to need an additional amount of debit. Okay. And remember, we're basically going to take it if there's a balance in this paid in capital from treasury stock transactions, we're going to take it out of this piggy bank. This is gain. now we're taking a loss, so we're going to kind of draw it down from here. So this is going to be coming from this account. Okay. So now at the end of this, the balance is 4,700. Okay. And this account balance is 0. All right. Is everyone good with that? Okay. So now let's do the hypothetical where we switch the order of these two. Okay. So we're going to first, so just pretend like we're kind of like, this is all correct, but let's just pretend that we just are starting from here. Okay. So I'm going to get rid of some of this stuff and let's see how it's going to change what we do. Okay. So if we first had this transaction happen, sold 900 shares for $9. Okay. It's going to happen on September 22nd, where this is going to be unchanged. We're still going to get this much cash. Remember, it is just 900 shares times $9. This is going to be the same because we still bought them for $11 each. This amount is going to be the same, but since we don't have any balance here, what are we going to do? What should we debit? We have zero balance here. We haven't done that transaction where there's a gain. So we can't just debit this 1800. This has to be a credit balance or zero. So where should we debit this 1800? Yeah, retained earnings. Okay. We're going to take this out of retained earnings. Okay. So we would have had some starting balance. Let's say we had $150,000 of retained earnings. Now this loss, we're going to kind of reduce this 1800 because we took a loss. We spent $11 per share and we're selling it back at 9. So it makes sense that our equity balance is going to go down because our net worth went down. We lost money on this whole transaction. Does that make sense? Yeah. Okay. So now we're going to do this other transaction where we sold. Okay. So then let's just finish this off too. So we did 9,900 and this was for 900 shares. So right now our balance is this minus this, and we have 500 shares left. Okay. So now we're going to sell those other 500 shares. Again, the cash is going to be the same as this, 12,000, which is equal to 500 shares times $24 each is going to be the same as this. Because remember, this was 500 shares times $11, our cost basis. Okay, so now this we would put in paid in capital from Treasury stock transaction. In that case, we would have, this is going to go to 0. So we end up with 0 shares, as we should. And this is 6,500. Okay, so um, now the net equity is the same. The order didn't matter. It's just that in the previous example, if you remember, we had, this is version 2. Version 1 of this was this, and we had 1,800. So we had a balance of this minus this. And this is version 2. Version 1 of this was this not existing. Okay, so if we look at the total balance of equity from version 1, we have this balance plus this, right? These are both the version 1s. If I take the version 2s, I have a larger balance here, 6,500, but I have a smaller balance here. Okay, so if I take version 2 retained earnings plus version 2 of this paid in capital, you can see that the equity balances are the same. The total equity is the same. The order just kind of changed what accounts they're in within equity. Version 1, again, was the traditional order that the problem was stated in. Version 2 is when I just reversed the order. Okay, but the end point, the net change to equity is the same. It's just, again, been split because the order did matter as to how we were going to account for it. So I switched the order of these because I sold a total of, like, I basically bought 1,400 shares and I sold 1,400 shares, right? All I did between these version 1 and version 2 here. So version 1 is when I, as this one said, I first sold these 500 at a profit and then I sold the 900. Then I would have got, my T accounts would have been version 1. It would have ended up like this, and my retained earnings would have been like this. Instead, if I reverse the order of those transactions, meaning I sold those 500 shares at a loss, and then, or what was it? Not, sorry. If I first sold these 900 shares at a loss, and then sold these at a gain, it would have resulted in this version 2. I was trying to demonstrate that the order actually does matter, because if you took that loss first, you wouldn't have had a balance in this paid in capital to, like in the first version, this is the first version, right? Since we got this gain, we have this balance, right? We could then take it out when we had a loss. If you reverse the order, this loss, you don't have that paid in capital account because you're taking the loss first, right? So in that case, we had to take the loss to retained earnings. And then in the second transaction, we had the gain. We would have the balance there. Like in the real world, maybe you're going to have the loss transaction first, right? You're not always going to have this paid in capital from treasury stock transaction happen first, so you have a balance in it. It could have went either way, but it would have changed how you counted for it depending on how it went down.